How does a financial report that looks like a victory lap instantly transform into a gruesome battlefield casualty report? And when consumers are cashing in on deals so good they feel illegal, how many of us ever stop to think that the bill for this free lunch is forcing an entire industry to dance on the edge of a cliff, staring down into an abyss of colossal losses? Today, we're diving into some hardcore, blood-soaked reality. We're talking about the recent war in the internet sphere, a conflict so brutal it makes the Battle of Verdun look like a schoolyard scuffle. I'm talking about the Great Food Delivery War. And at the epicenter of the blast zone, the titan, Meituan, and its absolutely blood-soaked financial report. The company's boss, Mr. Wang, didn't see his empire collapse, but you can bet his heart was bleeding profusely. We're talking about 12 billion yuan. Poof! Gone in a single quarter, evaporated faster than an ice cream cone in Guangzhou summer. The sight sent the capital markets scrambling, packing their bags and running for the hills, causing the stock price to perform a spectacular freefall. The story begins with that financial report, the one that gave shareholders a collective heart attack. In Q2, Meituan's revenue was 91.84 billion yuan. Sounds nice, right? A handsome 11.7% year-on-year growth. Time to pop the champagne, you'd think. Not so fast. Take a closer look. Net profit? A mere 1.49 billion. That's a catastrophic 89% drop year-on-year. Let me put that in perspective for you. In the same quarter last year, they made 13.6 billion. This year, 12.1 billion of that has vanished into thin air. This wasn't just getting cut in half. This was being minced into dumpling filling with the ashes scattered for good measure. Their core local commerce segment, the food delivery and in-store group deals we use every day, saw its revenue grow to 63.3 billion. But the profit? Just 3.7 billion, a staggering 76.6% plunge. The profit margin crashed from a healthy 25.1% last year down to a pathetic 5.7%. These numbers paint a picture of a bodybuilder, all bulging muscles on the outside, but an internal scan reveals massive internal bleeding. Meituan itself admitted it, right there in black and white in the report. The main culprit? That brutal, all-out food delivery war. It all kicked off early this year when JD.com suddenly announced, "We're doing food delivery now." JD's strategy was simple, brutal, and I can only describe it as a 7 wounds fist approach. A martial arts move that damages your opponent, but also critically wounds yourself. They came out swinging with the ultimate trump card, 0 commission. Any merchant who signed up before May 1st, 2025 would pay no commission for the entire year. For businesses suffocating under the weight of platform fees, this was like rain in a drought. Their eyes went green with greed. But that wasn't enough. JD threw another punch. Full social insurance. The 5 insurances and 1 fund for all its full-time riders, with JD covering the entire cost. This struck right at the Achilles heel of platforms like Meituan, which have long relied on a vast but less protected network of gig workers. This wasn't just competition, this was an attempt to rip out their very foundation. And just as JD set up its battle lines, another heavyweight entered the ring. Alibaba's Taobao flash purchase, think of it as a supercharged version of the ELM camp. They stormed the summer market armed with 50 billion yuan in consumer coupons. Incredulous! Deals like 16 off of 16 and 21 off of 25, this level of subsidization was simple and crude, it was terrifying. It rocketed their daily orders to 90 million. This wasn't a subsidy. This was literally setting piles of money on fire just to bring the market to a boil and roast their competitors over the flames. Faced with this 2-pronged assault, what could Meituan do? Surrender? Mr. Wang had to grit his teeth and fight back. And so a subsidy-fueled meat grinder on the scale of Verdun erupted. Meituan was forced to match the insanity. Red packets, delivery fee waivers, discounts cranked to the absolute maximum. The cold hard numbers in the financial report revealed the price of this war. Sales and marketing expenses skyrocketed from 15.6 billion in Q1 to 22.5 billion in Q2, a 44.8% jump. As a percent of revenue, it shot up to 18% to 24.5%. That extra 7.7 billion, that was the cash burned in the trenches, fighting JD and Taobao to keep users, retain merchants, and stabilize their rider network. And did it work? Well, yes. Meituan's daily order peak hit a mind-boggling 150 million, and user activity reached a new high. But the cost was that blood-soaked profit statement we started with. 12.1 billion in profit. Gone! It's like running a restaurant where the place is packed, but every single dish is sold at a massive loss. At the end of the day, you realize the revenue doesn't even cover the chef's salary and the rent. On the earnings call, Wang Xing was defiant. He said, "We oppose involution, but the fires of war have been lit, and Meituan must defend its position." He declared that short-term subsidies would continue, prioritizing growth over profit. In plain English, we're going to keep losing money because we have to. But the capital markets weren't buying his brave words. They voted with their feet. Meituan's stock price plummeted by over 15% at one point, wiping out nearly 100 billion in market value in a single day. The panic among investors was palpable. When would this bottomless money pit ever end? Of course, Meituan isn't just sitting there bleeding. They're making moves. On one hand, they're overhauling their rider system. At the end of August, they announced plans to completely eliminate fines for late deliveries by the end of 2025. This is huge. The old model of using high-pressure fines to enforce timeliness is on its way out. In its place is a points-based system. Lose points for being late, gain points for being on time. They're also rolling out a safety score in over 100 cities, offering cash rewards for not running red lights. The data shows this has already reduced red light running by riders by 26%. It's a clear shift in their algorithm governance from a culture of punishment to one of rewards. It earned them some good PR, but expecting it to fill a 12.1 billion yuan hole is, frankly, like trying to put out a forest fire with a water pistol. Skeptical, but fair. On the user side, they've launched new initiatives like quality satellite stores and Chef's Break Kitchen to play the food safety and premium service card. It's a good idea, the right direction even. But here's the problem. Consumers have just been force-fed a diet of JD's zero commission and Taobao's 50 billion in coupons. Their appetites have been spoiled. You talk to them about food safety, but all they care about is whether your discount is big enough. Besides, these new projects are expensive and slow to yield results. They are a distant water that can't quench a nearby fire. And as if things weren't bad enough, just before the report, a flood of user complaints emerged about delayed refunds and app failures. Meituan's customer service issued a late-night statement admitting to abnormalities in payment channels, but stressed that no funds were lost. But who cares about that? If my refund isn't instant, it's a bad experience, period. And when you remember the ghost of Mobike's deposit scandal, the words refund delay are like pouring salt on the wound of user trust. A bloodbath of profits combined with a crisis of trust. What Meituan lacks right now isn't cash. They still have over 170 billion on the books. What they lack is the confidence of users and merchants to keep entrusting them with their money and their business. And you think it's just Meituan suffering? Don't be naive. JD has been dragged so deep into this quagmire, they can barely recognize themselves. JD's Q2 report showed a net profit attributable to shareholders of just 6.178 billion, a 51.14% drop, representing a 14.7 billion yuan loss compared to a profit previously. Revenue looked great, up 22.4% to 356.7 billion. But lift the hood on their new businesses, which is mostly JD food delivery, and the sight is horrifying. An operating profit margin of negative 106.7%. Let me repeat that. For every 100 yuan of food they sold, JD was losing 106.7 yuan. The more they sold, the more catastrophic the losses. JD's marketing spend in Q2 was a staggering 27 billion, a 127.6% increase. Most of that went straight into delivery subsidies. What did they get for it? In 5 months, they hit 25 million daily orders, covered 350 cities, and attracted 1.5 million restaurants. Dazzling data, built on a foundation of bleeding wounds. Even JD couldn't sustain it. They quietly began adjusting their strategy in July. On August 1st, they issued a formal notice to regulate subsidies and oppose vicious competition. The CEO, Yuan, was even more blunt. The food delivery market since July has been a bubble. Vicious subsidies offer no model innovation and create no incremental value while causing great trouble for merchants. Translation: if we keep fighting like this, we're all going to die together. Just as Meituan and JD were locked in a death grip, their profits incinerated, the referee finally had enough. The government stepped in. On August 23rd, 3 major government bodies jointly released a draft of the Internet Platform Price Behavior Rules. It slammed the brakes on this no-holds-barred cage fight. This document, dubbed the Anti-Involution Guide by the industry, had 2 core points. 1. Platforms are forbidden from selling goods and services below cost. That means your zero commission, 16 off 16 loss-leading promotions? Not a chance. 2. Platforms cannot force merchants into either-or exclusivity deals or compel them to participate in loss-making promotions. The merchants who've suffered under the platforms for so long finally had regulatory backup. The warning shots had been fired long before. On July 18th, regulators had already summoned Meituan, JD, and ELEME, explicitly demanding rational competition. By August, the platforms had all issued statements pledging to resist vicious competition. The deterrent effect of regulation is immense. Looking to the future, the market widely expects that as the summer peak season ends, the subsidy intensity will gradually decrease. The competition will shift from the barbaric stage of he who burns the most cash is king to a more refined phase of operational excellence, who has stable service, higher efficiency, and a better ecosystem. The first season of the food delivery war, the cash-burning chronicles, is over. So what did this multi-billion-dollar brawl actually accomplish? For Meituan, a crippling blow. Its profit foundation was shaken, with margins collapsing from 25% to 5.7%. 12.1 billion in real money gone. The stock tanked. Shareholders are furious. They're now riding a tiger they can't get off of. For JD, their new business segment is a black hole of losses, a negative 106.7% profit margin and a 14.7 billion loss. They were burning 160 million yuan a day. They grabbed about 10% of the market, but the cost was devastating, and they're already in strategic retreat, admitting the market is a bubble. For users, we got to fleece the system. $5 milk tea, $10 fried chicken, we briefly achieved food delivery freedom. But there's no such thing as a free lunch. This generosity was funded by burning investor cash. It's unsustainable and could compromise future service quality and choice. Once the tide of subsidies retreats, those cheap meals will just be a memory. For merchants, they might have gotten more orders, but being forced into endless promotions meant their actual profits were thinner than ever. The promise of zero commission was often negated by the hidden costs of mandatory marketing campaigns. For writers, more orders may be temporary bonuses, but the rules got stricter. Meituan talks about canceling late fees, but the pressure of points and safety requirements remains. A superficial pay bump was often exchanged for higher intensity and greater risk. For the capital markets, the stock plunges expressed a deep-seated fear and disgust for this chaotic cash-burning model. Capital, after all, seeks profit, not a perpetual subsidy black hole. And though the only lesson we learned from history is that we never learned from history, allow me to offer a few hard truths. First, there is no iron throne in the internet world. Meituan's dominance isn't welded in place. Yesterday's cash cow can become tomorrow's money pit. Second, subsidy wars are a self-destructive lose-lose game. You might win some data, but you destroy profits and the health of the entire ecosystem. Meituan and JD burned nearly 30 billion yuan between them for what might be only a temporary shift in market share. Third, the wool always comes from the sheep's back. The ultimate bill for this war will likely be paid by users, merchants, or riders in the future. Fourth, real progress comes from technology, not just burning cash. Drone delivery, AI dispatching, these are the black technologies that can actually lower cost per order. They are worth 10,000 times more than any coupon. Fifth, a healthy ecosystem requires balance. The old way of squeezing merchants and riders is no longer viable. Platforms that only think of their own profits and not the survival of their partners will not go far. Sixth, do not cross the red line. The classic internet playbook of burning cash to achieve a monopoly and then hiking prices is now extremely risky. And finally, capital's patience is finite. No matter how much cash you have, you can't sustain massive losses forever. Investors demand a clear path to profitability. Strategic losses can't be an excuse forever. The end game of this cash-burning spectacle must eventually return to the essence of business, providing solid service, maximizing efficiency, and building a healthy ecosystem where people are willing to pay for your value sustainably. After all, no company can survive by losing money forever, just as no one can live a life of poetry by constantly borrowing money. When the tide of subsidies finally goes out, we'll see who was actually wearing swimming trunks. So, friends, the next time your phone buzzes with an outrageous offer like 15 off 20 or a $3 delivery coupon, don't hesitate. Take it all, because those coupons are printed with the very real money of Meituan and JD's shareholders. They are bleeding cash to buy you dinner. This golden age of fleecing the system is destined to be as fleeting as youth itself. So enjoy it while you last. The first season of this bloody drama in the food delivery world, the great cash burn, has come to a close. But the Jianghu, the world of conflict, is never calm. Season 2, the battle of efficiency and service, has only just begun. We'll be watching to see if Meituan can stop the bleeding and what new moves JD and Alibaba will make. Capital's drums beat a furious sound. Giants toss cash on the battleground. Users grab deals with joyful laughs, while balance sheets bleed in crimson drafts. Riders race on soaked in sweat and toil, from merchants' profits in endless turmoil. At last, the regulator's hand descends. On this mad, vicious cycle, the chaos ends. The road is long, the game is old and gray. Burn all the cash, there's still a price to pay. That's all for this episode. Thanks for watching, and we'll see you in the next one.